Estimating extreme cancellation rates in life insurance. This paper assesses the risk of a mass lapse event in life insurance. The rarity of the event and the complexity of policyholder behavior make the risk assessment of such a scenario difficult. Using a simulation study, we evaluate how different estimation methods can assess the risk of this scenario using panel data at the company level. We then use the best performing method to estimate the probability distribution function of a mass cancellation event in the United States and Germany. We identify dependencies of the event on company and country characteristics which haven't been taken into account by regulating agencies. We also find that the current mass lapse scenario in Solvency II has no empirical foundation for the German market. We show that an empirically valid scenario leads to a significantly lower solvency capital requirement for the average German life insurer. Rare events with extreme consequences often have a profound influence on economies and their economic agents. The 9/11 terrorist attacks led to considerable changes in many economic sectors, such as the airline industry. Hurricanes such as Katrina and Sandy have shaped how we see flood protection and insurance. Financial crises such as the Great Depression and that of 2009 influence our consideration of financial regulation and economic risk in general. For organizations, extreme events can similarly shape existence. One such extreme event for life insurance companies is the occurrence of a mass cancellation event, that is, a large portion or even a majority of the policyholders who cancel their life insurance policy abruptly. Even though policyholder cancellation behavior has received considerable attention in the academic literature, the question of how to model mass cancellation scenarios has received scant attention. This is surprising because the possibility of mass cancellation has a large effect on insurance companies' asset liability management and leads to one of the largest financial reserves in the European risk management framework Solvency II. This omission in the literature can be explained in part by the data requirement associated with estimating extreme cancellation events. Extreme cancellation and its associated rates is a rare event, thus data sourced from only one insurer are not sufficient to estimate this tail risk. In this paper, we address this challenge by employing the estimation approach of Chavez-Desmoulins et al. 2016, which is based on extreme value theory and can be applied to panel data. We consider cancellation rates as realization of random variables but do not make any assumption about their distribution function except that they are continuous. This method enables us to estimate the unknown probability distribution function and associated risk measures for extreme cancellation events from readily available panel data at the company level. Depending on contract characteristic, cancellation can either negatively or positively affect an insurer's profit. Unexpected changes in the level of cancellation rates can lead to liquidity problems, the loss of expected future profit, and unbalanced initial expenses. Life insurers are thus interested in assessing their exposure to this risk as accurately as possible. U.S. life insurers can potentially face very high cancellation rates, particularly after premium guarantee periods expire. The possibility of such an extreme event needs to be taken into consideration for a company's asset liability management. In other situations, however, cancellation can increase an insurer's profit as policies are usually front-loaded and a cancellation allows insurer to reap the early profits without having to incur expected losses in the later part of the policy's life cycle. In each case, understanding cancellation behavior is crucial for life insurers to ensure adequate asset liability management. For the European market, the importance of understanding the cancellation behavior of policyholders has become critical with the introduction of the new regulatory framework Solvency II. The Framework Solvency Capital Requirement or SCR has a great sensitivity to lapse risk. In the standard model of the regulation framework, the mass lapse shock leads companies to have solvency capital requirement in the hundreds of millions. Because insurers have to apply a scenario in which 40% of all policyholders cancel their contract in the same year. This assumption doesn't have an empirical justification for the assumed size of the shock or account for the fact that the same shock is assumed for all the different national markets in Europe. Our model offers a way to use empirical assumption appropriate for the individual national insurance market in the lapse risk module, which can help to limit the risk of possible over or under reserving. Previous literature on cancellation event in general has used two approaches, estimating cancellation rates from data directly or calibrating economic models based on specific assumptions about macroeconomic factors and policyholder behavior. These approaches differ in their interpretation. Empirical approaches often make fewer assumptions than do other approaches but seldom allow for a casual interpretation of the result. Model-based approaches identify causal relationship but assume specific relationship between policyholder behavior and macroeconomic factors which may not hold. For extreme cancellation events, some theoretical modeling approaches exist, but as of yet, no empirical estimation have been reported. Applying the estimation method to data sourced from U.S. life insurers demonstrates the applicability of our approach and shows the importance of the product type for high cancellation rates in the U.S. market. Although mass cancellation scenarios with rates up to 50% can be adequate for companies with a high share of term life policies, a mass cancellation scenario for companies with a high share of permanent life insurance policies is estimated to be approximately 20%. Further, we consider the calibration of Solvency II's mass cancellation scenario using German data. Our results show that cancellation rates of 20% until 25% reflect a mass cancellation scenario in the German life insurance market. These values raise skepticism as to whether the arbitrarily chosen cancellation rate of 40% for this scenario in Solvency II is adequate for the German life insurance market. In both the US and German markets, the severity of the extreme cancellation event is decreasing in correspondence with the size of insurers' portfolio and increasing in proportion to the amount of new business. This encouraged further research on other company-specific variables. The combination of this result and that the mass cancellation scenario can depend on the predominant product type sold in a market call into question whether a uniform mass cancellation scenario for all European life insurance markets is appropriate. European life insurance markets differ in their company characteristic and in their dominant products, and might thus differ in their mass cancellation scenario as well. Thank you.